Real estate investment trusts have suffered a dip in recent weeks. On average, they've dropped by 13%, but there are many individual REITs like Realty Income that have dropped by over 20%. The reason why they are selling off is because there's growing uncertainty about future inflation, and as a result of this, the Fed has decided to take a pause and stop rate cuts for the time being. So far, the thesis for investing in REITs relied heavily on rate cuts. The thought was that REITs crashed because rates were hiked, and therefore they should strongly recover now that rates are cut. But if rates aren't cut after all, why invest in them? That's what many investors are currently asking themselves, and I fear that many are now losing interest because the Fed has guided for less cuts in 2025. If that's you, I'm here to warn you. Rate cuts aren't over, they are simply being delayed a bit to make sure that inflation isn't accelerating. But if you look at the long-term projections of the Fed, also known as the dot plot, you'll see there that they still expect interest rates to land around 3% by the end of 2027. I'll put that on the screen and you'll see clearly there that the market is now pricing fewer rate cuts in 2025 than it was just 6 months ago. However, the end outcome is still expected to be more or less the same, with interest rates returning to about 3% within a few years from now. Therefore, if you're a long-term oriented investor like myself, I think that this is a great buying opportunity because REITs just recently gave up a good portion of their gains simply because most investors are impatient and excessively focused on the short-term prospects. But in reality, the long-term prospects, the bigger picture really hasn't changed much at all. REITs are today still priced at near decade low valuations, and that's despite inflation returning to pre-pandemic levels of about 2% and the Fed already cutting interest rates by 100 basis points. I think that once we move past the current uncertainty about inflation and the Fed resumes its rate cuts, we'll see also REITs continue their recent recovery. Therefore, now isn't the time to give up on REITs. On the contrary, I'm now doubling down on some of my top picks going into 2025. Lots of REITs are today still priced as if we were facing a higher for longer interest rate environment, but I think that this is highly unlikely. What you need to remember here is that the Fed hiked interest rates at an unprecedented pace because inflation was really hot. And why was inflation hot? It was because of the pandemic. It led to significant stimulus spending with those stimulus checks. It led to distorted consumer behavior because we couldn't spend on certain services, so we're spending on goods instead, especially since we're receiving those checks. And then finally, there were also significant supply chain issues happening right as there was a lot of demand for certain specific types of goods. And so naturally, when you have high demand but limited supply or even decreasing supply, you're going to get price hikes, you're going to get inflation. But this was just temporary, and by now inflation has already returned to below 2%. It's been there for about 1.5 years if you adjust for real-time shelter, and this has given the Fed enough confidence to already cut interest rates by 100 basis points. It has clearly guided that it will continue to cut interest rates. It's simply taking a break, as I mentioned earlier, and I personally think that this is in large part because of the change in administration. This brings uncertainty naturally as President Trump has talked about mass deportation, tax cuts, significant tariffs, and if we get a trade war, this could lead to an acceleration in inflation. The market worries about this. This has already caused long-term interest rates to surge much higher. And naturally, the Fed is now taking a pause to make sure that, things remain on track. But really, if you can think long-term here and ignore this short-term bumpiness and uncertainty that we're facing, we remain confident that the trend will continue towards low inflation and low interest rates because I think that we are returning to our pre-pandemic economy now. And as I've discussed in a recent market update, the 5 horsemen of disinflation remain today stronger than ever. Those are the demographics, technology, inequality, globalization, and over-leverage. All those factors are today leading to much lower GDP growth, lower inflation, lower interest rates. If you want to learn more about this topic, I've removed the paywall of this recent macro update so you can read it completely for free. It will be the first link in the description of this video. But this is really what gives me the confidence that interest rates will return to lower levels over the coming years. And so this explains why I'm so happy to buy this dip. I think that it occurred because of the impatience of the market. It happened because most investors are excessively focused on the short term, and it is true that there's growing uncertainty right now, but the long-term outlook, the bigger picture hasn't changed much at all. Yet these REITs are now a lot cheaper, despite already having enjoyed significant rate cuts. And so with that in mind, what REITs am I buying today? One great example that we bought more recently is called Vesta REIT. Its ticker symbol is VTMX. It's our top pick for industrial real estate right now. It's the leading industrial REIT in Mexico, and it's unique in that it's listed in the US, and this gives it access to American capital at a lower cost. It can raise American debt, American equity. This is typically cheaper than what you get in Mexico, and then it's able to deploy these proceeds into investment opportunities, mostly development projects in Mexico, which come with much higher yields than in the US. And so it's able to, arbitrage the spreads, which are graded this way by raising capital in the US, reinvesting in Mexico. Its average cost of capital is today about 6%. It's able to deploy that into development projects at 10%. This is resulting in rapid growth. The company just recently held its investor day, and there they guided to grow their FFO per share by about 10% annually over the next 3 to 5 years. This is really rapid growth for a REIT, and yet today it's trading at just around 12 times FFO. I don't know any other REIT that's growing at this pace and trading at just around 12 times FFO, especially considering that the REIT also has relatively low debt. Its LTV is only about 25% right now, and this should allow the REIT to grow organically now going forward without having to raise additional equity. It can simply add more debt on its balance sheet to get closer to its 40% target. But so in short here, really, I like this REIT a lot because you get high growth at a low valuation. And of course, I understand that Mexico is a riskier country than most other developed countries. But also what you need to remember here is that most of its tenants are big multinational companies like Home Depot, Amazon, Foxconn, Iron Mountain, and so on. So this mitigates risks. It also earns most of its rental income in hard currencies like the US dollar. This mitigates risks further. And again, it has a listing in the US. I also like that. And so I view this as a risk mitigated way of investing in high growth Mexican real estate. Then another REIT that I've been buying lately is called BSR REIT. I've mentioned it many times on this channel, ticker symbol HOM.U in Canada and BSRTF in the US. It's an apartment REIT, a small cap apartment REIT that invests in Texan markets. It's focusing primarily on Austin, Dallas, and Houston. I think that these markets will enjoy some of the fastest population and job growth over the next 10 years. I expect this to lead to growing rents and asset price appreciation, and yet the REIT today is still trading at a 30 to 35% discount to its net asset value, which I think is also conservatively estimated. The management has been aggressively buying back shares to create value for shareholders. They are big shareholders themselves. I really like the alignment of interest there. And over the coming years, I think that the company enjoys significant catalysts because firstly, interest rates will keep going to lower levels. As I mentioned earlier, I think that this applies to most REITs, but BSR specifically has another catalyst, and that is that I expect its rent growth to also accelerate because apartment REITs have struggled a bit in recent years, especially those that focus on Sunbelt markets because there was some oversupply. But one consequence of the recent surge in interest rates is that it has put most new development projects now on halt, and so the new supply deliveries should fall off very significantly already in mid-2025 and even more so in 2026. And this is expected to lead to a significant boost in rent growth. And I think that the combination of lower interest rates with faster rent growth is a very powerful catalyst for these undervalued apartment REITs like BSR REIT. And I think that could lead up to 30 to 50% upside from here while you wait to earning also a 5% dividend yield. To finish this off, I want to remind you that patience is richly rewarded when investing in REITs, and unfortunately today I'm seeing a lot of smart investors make the classic mistake of losing patience and giving up on REITs because it is true that they've underperformed now for years, and so it's understandable that some investors will lose patience in them, but this is unfortunate because in my opinion this is the exact time when you should get interested in a sector, and you should perhaps even double down because historically REITs, when they've been so heavily discounted, they've been extremely rewarding in the following periods. There's a lot of studies on this. I'll put one on the screen that shows you that historically REITs have delivered a 90% total return over the next 3 years after they've been priced at a 20% discount to their net asset value on average. I think that valuations are even lower than that today after having underperformed for so long. And so there's a very clear correlation between valuation and future returns. Today valuations being very low and REITs enjoying significant catalyst in interest rates, but also accelerating rent growth. I think that the next 5 years are going to be very rewarding, but those returns are not going to be consistent, and it's going to be a bumpy ride with some uncertainty, just as we have right now. But I don't think that the long-term outlook has changed, and for this reason I keep accumulating more REITs. And by the way, if you want to access all my transactions in real time, as well as my entire portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. It will be the second link in the description of this video. You won't be charged anything for the first 14 days, so you can just join us, take a look at the research, have a look at my portfolio. If this investment style interests you and you want to stick with us for the long run, you also get a discount for starting today. Otherwise, thank you very much for your interest. If you could please click the like button, that will help me a lot to keep on growing. Subscribe to the channel. Thank you and see you at my next one. Bye-bye.